The fear factor that had predominated in January continued into February. All the concerns about a global slowdown for all the reasons we've talked about, the problems in China, the collapsing commodity and oil and so on, in emerging markets. But I think what became a bigger concern in the first part of February was the fact that central banks around the world, in the developed world, are now looking at zero interest rate policy for a long period ahead, in some cases negative interest rates, the European Central Bank and the Bank of Japan. And people were saying, well, if that's going to carry on, the damage to the banking sector, profitability, is very serious. Together with a turn in the credit cycle, which will come in due course, and has already happened in some parts of the world, the emerging world, people started to sell off banks very sharply indeed, which is always a worry because the banking system is at the heart of the economy, of course. So there were very sharp falls, particularly in European bank shares, but right across the world in the first couple of weeks of February. But intriguingly, when we got to the middle of the month, the fears were being overdone, sentiment began to pick up, and there were a couple of factors in particular that helped sentiment to turn. I think most notably the fact that the oil price began to recover. From its January lows, it's now up by almost a third. And the other important thing is that the data on the economies in the developed world has not been as bad perhaps as people thought. So we saw a recovery in markets in the second half of the month. By the time we got to the end of the month, global equity markets were down only marginally on the beginning of the month, having had a very sharp fall in the first couple of weeks. So a very distinct improvement in sentiment and therefore price action in the final couple of weeks of the month. The negative factors that we've seen now for the past couple of years, the big ones are the slowdown in China, which is now a matter of fact. I think we've talked about it for a long period of time. I think most people now recognise that China is indeed slowing on a structural basis, resting too with a credit boom which has to be unwound. So that China being such a big economy, that definitely has an impact on global growth. We're seeing the impact of that. Collapse in the oil market has had funnily enough, a negative impact on growth so far because it's been damaging to capital spending, and the big oil companies and the service providers are big spenders of money. That's been curtailed by hundreds of billions of dollars, and we haven't yet seen the benefit to you and me coming through in terms of sort of lower energy bills. So there's been damage there. The emerging world has gone into almost recessionary conditions, in some countries into deep recession. Brazil and Russia are good examples. All of that is factors which have caused the sort of reassessment of global growth prospects for this year, and people have been steadily shaving off growth forecasts for the next couple of years. And indeed, some people have been even saying the world is going to go into recession. I think the important point to make, and we've made it in previous recordings like this, is that yes, we recognise that there is some hit to global growth, but the factors that underlie growth, particularly in the consumer sector, and the lower oil and commodity prices will flow through to higher consumer spending. We're seeing some evidence of that. And the encouraging thing in the past couple of weeks or so, the data coming out of the developed world is showing that, yes, economies have slowed down a bit, but not dramatically, and certainly not falling into recession. Most importantly, the biggest economy, the most important of all, the US, recent data has actually been on the surprise side, the upside surprise side. So people are saying, well, actually, the US isn't so bad after all. So that's a very important factor. So a combination of oil price bouncing and then data coming out of economies in the developed world not so bad, I think has encouraged people to feel that things are perhaps through the worst in terms of repricing of those concerns into securities prices. Well, I think the most notable one was the fact that we've known for some little while that the UK was going to call a referendum on staying in the EU or not. And the date has now been set, June the 23rd. We've got a 4-month period ahead where we won't know the outcome. And incidentally, the referendum is a clear in or out vote. There's no ambiguity about it. The first signs of wobbles in the markets came very shortly after the announcement of the referendum was made, and the Out campaign was actually, I think, supported by some very high-profile cabinet ministers actually joining the out campaign. So you've got a lot of political dynamics going on here. Of course, we don't know the outcome. The polls are showing it's pretty close. The bookmakers, which are more reliable, are showing it's not that close, that we're likely to stay in, but it's definitely creating uncertainty. And of course, investors, if there's one thing investors don't like, it's uncertainty. Where does that get reflected, first of all? In the currency. So sterling has had quite a big fall. And actually, my guess is that sterling's fall so far is discounting the probability, which is probably about 40% of the UK coming out of the EU. But we've got 4 months of wobbles. So I think asset prices in the UK, and sterling in particular, will continue to come under a bit of strain. But the outcome is binary. If we stay in, sterling will recover pretty quickly. We still face lots of uncertainties, and we've talked about them a lot previously and a little bit today. There are lots of uncertainties out there and some big issues, and the world is going to continue to grow quite slowly, but it's not going into recession. And I think there's now a bit of recognition that things perhaps aren't quite as bad as people were fearing in late December, January, early February, when markets really fell very sharply. We had the worst setback in markets since the global financial crisis. So a lot has now been discounted. Things aren't that bad. We're not facing a global systemic problem. Bank share prices were ridiculously weak. Bank capital is restored to much healthier levels than we've seen for decades, much stronger than pre-crisis. So I don't think we face as tough a set of conditions as the markets were suggesting. And I think a lot has now been repriced into markets about these sorts of risks. So with valuations now lower than they've been for quite some time, albeit in a tough environment still, I think this is a very good opportunity to add to risk in portfolios. And I think we will see this modest recovery that has started. I think we're going to see that continue over the course of the next few months.